This is Rich Munroe again, back on our BNB Investing Live. Sorry about that. We had a technical difficulty. We kind of got kicked off of the Facebook live feed for some reason. So hopefully you guys can jump back on and we can continue the conversation with Mark. Just starting to kind of dig into some of the details that a lot of you might be curious about. And so I think where we fell off, I was asking Mark specifically about those of us, and there's a lot of us, that are buying properties distressed and in bad shape, and basically rehabbing them. So throw in the comments for us again. Just want to confirm if you can hear us okay. I know we've been having some issues with the mic, so I apologize for that. But so Mark, if I'm out there looking for properties and I'm specifically buying distressed properties to rehab them and then make them into a vacation short-term rental, walk us through how we can, how you guys can kind of help us, and the steps that are involved with that process.
Okay. On the renovation side, I guess you'll call those loans a BRRRR. So you're buying it to renovate it, and then after renovating, you're going to rent it, refinance, and repeat the process. But with the loans that we do, you don't have to have it rented. The property could be vacant at the time of the refinance. So before you purchase the property, just make sure that the income that you're going to get, either market rent or the short-term rental income, would be sufficient to cover the debt, the new debt, when you refinance the property. That is extremely important.
Right. And so you guys can do the funding on the front end to buy the rehab as well?
And we can do the funding on the front end to buy the property and renovate it, and also the takeout for the long term on the back end.
All right. And what are your typical terms for the rehab purchase?
Well, that's driven based on experience. So it's a totally different picture for an experience.
Let's say I've got 10 rehabs I've done in the last 3 years.
So that'd be 90% of total cost, 75% of ARV, probably 8.5% interest only.
All right, and let's say I have zero experience. This is my first rehab.
70% of the ARV and 80% of total cost, 80 to 85% total cost.
Okay, got it. And then we would do the refi based on the same terms you typically would have available when you're actually purchasing the short-term rental.
Yeah, so let's take a look at it. So say on the takeout, your payoff on a property is $135, and the property ARV is $200,000. So on the cash out, we're doing 75% of the current market value. So you're looking at 150 would be your new loan amount. So you just have to be certain that the income that the property would generate is strong enough to meet whatever the debt service would be on that 150.
Okay. I know a lot of investors in our acquisitions business, like you said, you kind of leave the cash on cash return requirements to the investor, but we typically like to look at deals that are at a minimum 20% cash on cash return. And so if I'm buying the property for $100,000, just to keep the numbers easy, then that should cash flow at a minimum $20,000 in short-term rental revenue for each year. There are some investors that kind of shoot for 15% or 16%. I think it's just really what your appetite is for investments. We've done some recent deals where the returns are north of 25%, and so obviously the higher the cash on cash return as a barometer, in my mind, is kind of the better deal you want to try to go after. Now, I'm interested to know, Mark, how many of your clients are looking at specific vacation rental markets versus urban markets?
Wow, great question, Rich. The majority of the people that we deal with are in the destination markets.
Okay.
We don't get a lot. Probably the urban markets probably 20% of our business.
And what are some of those destinations?
You have Tennessee, so you're looking at Sevierville, Gatlinburg. You're looking at the Outer Banks of North Carolina. You're looking at Pawleys Island in South Carolina, and also Folly Island, South Carolina. In Florida, you're looking at Kissimmee or Reunion, Florida. You're looking at Santa Rosa Beach, uh, Panama City. In Alabama, you're looking at Gulf Shores. In Texas, you're looking at the what they call it, Fredericksburg. They call that it's a joke, but I'm not going to say it. But it's then you're looking at Lake. What's the name of the lake in Austin? Oh my God, I just got a request from the lake in Austin, outside of Austin.
Are you doing
And
any
then,
on Lake Lanier in Georgia?
no, we did
Okay.
one deal a couple of years ago on Lake Lanier. But the Poconos, we get a lot of requests for the Poconos, Catskills in New York. Um, there's a city in Scotland, Maryland, uh, in Breckenridge, Washington State, um, Anchorage, not Nebraska. Anchorage, Alaska is one of those areas that we have done quite a bit of business up there. And now we've been getting requests for Maui and Hawaii. Hawaii has a lot of condo tails. So, yeah, quite a bit of destination areas. And in New York, we have this a place called, I hope I'm pronouncing it correctly. I think it's Mantuck, New York. And properties normally, there was a seasonal rental. So for the summer months, say from May through September, a property may go for 60K a month on up. So we have had a few transactions in that area for investors because they have the New York City crowd that want to get away to this for summer vacation with their family.
Yeah, those are typically multi-million dollar homes, right?
Yes.
Right.
Well, you know what? Those homes, from a aesthetic standpoint, is not very attractive on the eyes for the outsider. Unlike when you're going into Sevierville up in Tennessee, or you're looking at the properties in Reunion, Florida, it's a totally different attraction from a beauty standpoint. But I guess the aesthetics of it and the location is what sells those properties.
All right, so that's good to know. So if I'm an investor kind of looking at some of those vacation destinations, you guys have several years of experience, lending in those markets. So you actually can help out with some of the due diligence and guide us for some people that are kind of starting into new markets.
Oh yes. And another market I forgot about, dude, is here in Georgia, and that's
Blue
the
Ridge?
Blue Ridge
Yeah, Blue Ridge
Mountains.
Mountains.
Blue Ridge. We just did a refinance on a new construction in Blue Ridge. So that's a very hot market right now. Very hot.
Yeah, we have a cabin that we manage up on Lake Blue Ridge in Morganton, but it's been getting hit lately with a lot of the lack of occupancy that's been going on in the last several months. So we're hoping to have it pick up here in the spring and summertime. So the last thing we need is a bunch more units up there. But I know they have Blue Ridge Mountains has I think several hundred of rental vacation spots up there, probably in the 500-600 range, from what I understand.
Oh yeah. So it's more of I'd say a niche market, put it like that.
Right, right.
Another spot that you get great returns, dude, is Reunion, which is part of the Kissimmee zip code. So you're looking at, I just did a property for a client and $2.5 million acquisition, and that property brings in $35,000 a month.
Okay.
So really good numbers. Debt service, everything on that came to 16 and some change, I believe, 15 and some change.
Okay.
So really good numbers on that property. Really good numbers.
All right. And then, so on the refinance, what are your typical terms on refinancing? What percentage of the appraised value the new appraised value are you able to lend on?
Well, we can go up to 75% of the appraised value with a 720 or better credit score.
Okay.
And if the property is currently being used as a short-term rental and you have 6 to 12 months of income statements, then we'll use the actual income from the property.
Got it. Okay. All right. So anything else on the individual purchase of an individual property that we haven't talked about already that you'd like to share with us?
So just to be aware when you're purchasing properties, especially if it's not a single family and you're purchasing a condo or condotel, especially when you're purchasing a condo, just be clear as to if it's a warrantable or non-warrantable condo. Because if it's a non-warrantable condo, then you want to see what's the density of the number of investment units within the complex. So that can have an impact if you get financing or not. So normally you don't want to have more than 30% of all the units that are owned by investors.
And those are usually places that have condo associations with them.
Yes, because you can have a property that's non-warrantable condo and meet the density requirement. It could be from various things such as they may have a high delinquencies on the HOA, but we can still get it done with a reduction in reduction in the LTV. But when you have a density issue, when more than 30% of the units are controlled by investors, then we have a problem. I have a deal now where the guy controls, there's only 30 units in the complex, and he controls 25 of those units. So therefore, there's a density issue, we call it concentration issue, because most of the units are investor owned. So it makes it a little bit more challenging to secure financing on that at a higher leverage. It's a great investment for the owner, but from a financing standpoint, it makes it a little bit more challenging.
Okay. All right. And then, we touched a little bit earlier on kind of multifamily or large number of property purchases. For those of us that are, active and have a lot of short-term rental units and are trying to aggressively grow our portfolio, I've got an example now of a deal we're looking at that's 57 single-family homes in a southern town of Georgia, and we are looking at the acquisition. They're all currently long-term rentals, but we are looking to potentially, carve out maybe 20 to 30% of them to do short-term rentals with after the acquisition. And so, if I'm looking at a transaction like that, how would you guys view that?
So if you're doing that, that would be considered a blanket loan.
Okay.
And so we have to, we'll look at each individual property. So even though it's a blanket, on a blanket loan, you have one mortgage that covers all properties under one umbrella. But we'll conduct an appraisal on each individual property and look at the income that each property is generating. Because each property must be able to meet debt service individually, and then you look at it as one. So for instance, if you have a property that is vacant, and then you have another property that's income is twice as much as the debt service, they have 2.5 or 2.0 in debt service, you can't offset the lack of income from the vacant property to meet the debt service. You have to be based on what that property is generating. So we'll need to see the income statement for each individual property. So that's the scenario you can get up to 80% LTV on a purchase.
Yeah, so if they're asking $4.5 million, we'd have to come up with 800,000 plus or whatever that works out to be.
Yes.
Okay.
But to let you know, Rich, on those, the rates are a little bit different because the rate is tied to the Treasury. So I just had one priced out yesterday. We're looking at on a 10-year note. So it'd be a 10-year note, 30-year AM. You're looking at it was 6.875 with a 760 credit score.
Okay, so it's a lower interest rate.
Yes.
And so the fact that I'm going to eventually convert some of those over to short-term rentals doesn't really come into play in the underwriting at all.
No.
What if I were to do a refinance after doing that?
Great question, because those loans come what we call with a defeasance fee. So, meaning that if you were to refinance it or sell the property, you can refinance all of the units, or you can sell all of the units, but you encounter the defeasance fee, meaning that if you refinance the property, there's a penalty associated with it, and also come with a yield maintenance. With the yield maintenance, you can buy it out for a quarter hit to the rate and replace it with a 5-year step down. So first year 5%, second year 4%, third year 3%, fourth year 2%, and the fifth year is a 1% penalty. So you have to take that into consideration when entering into a blanket loan.
Got it.
So
Okay.
you don't have the free reign to go to sell or refinance a property as if you were controlling them individually. But that's your only option if you want to finance, because no one person will finance 50 properties for a single investor unless it's a blanket loan, because that exposure individually is just too much to have on your books.
Got it. Got it. That makes sense. All right, so we're getting close to end time here. Is there anything else that we should know about your Airbnb financing that you guys provide?
When looking at these investment opportunities, the income could be incredible, but just ask a ton of questions. And the guys like Rich that's been in the space as an operator, property manager, really understand the ins and outs and the nuances of evaluating and analyzing the deal to make sure it makes sense based on your financial situation. Make sure you dot all the I's and cross all the T's before you pull that trigger. Because at the end of the day, once you sign on the dotted line, you're responsible for that debt and no one else.
Yep. Yep. No, that makes perfect sense. So Mark, I threw your website out in the comments section for this post. How do folks get a hold of you if they need to get more information?
You can call the office at, I don't even know the number, do it off the top. Our number is 470-447-2077. So that's 470-447-2077. Or you can go to the website, and if you click on to the far right, Airbnb financing, and then we have a information. You can just click on the link and just request more information for the property, and then someone will contact you and set up a time to have a conversation.
All right, I put your phone number in the chat as well, and along with the website. For those of you guys that reach out to Mark, make sure that you let them know that you're a member in the BNB Investing group, and I'm sure he'll accommodate some special pricing and hopefully lower origination points for us. Right, Mark?
We'll do what we can for you, dude. It's on a case. Hey, Rich, it's on a case by case basis. I can't make any promises, blanket promise, without looking at the deal. Each deal is different.
Totally understand.
But one thing I can guarantee, though, dude, we'll do the best that we can to get the loan done.
That's all that matters. Do the best that you can.
That's the only thing I can promise you right now.
No, that's awesome. So listen, I appreciate you jumping on, and I definitely want to invite you on again at another point. I know that there were some issues with your camera, and we can definitely look forward to reaching out. Like I said, I always kind of check in with Mark on some of the deals that we're looking at, just to kind of get a gauge. A lot of his experience looking at multiple deals kind of comes into play as well, and so he might recognize something that's a risk that you're overlooking. So that's always good to have a strategic partner like Mark that's got that experience. So thanks again, Mark. I appreciate you jumping on with me.
You're welcome. All right. Thanks, everyone. Enjoy your day.
Thanks, Mark. And so we're going to shut it down. So BNB Investing Group, again, we help investors kind of navigate whether they want to do master leases, whether they want to do acquisitions or whether they want to manage other people's properties. And we have programs that are specific and customizable to what your goals and objectives are. And so if you're interested to hear a little bit more about that, feel free to reach out to me with a direct message, and we'll be happy to schedule a quick call and talk about that, see if you'd be a good fit for some of the programs we have. So thanks again, Mark. I appreciate it, and take care. We'll see you soon.
Okay, bye-bye.
All right.